Welcome to our channel. Are you curious about real estate? Whether you're a seasoned investor or just starting out, you've come to the right place. In today's video, we'll be diving deep into the world of real estate, covering everything from the basics to advanced strategies. Get ready to unlock the secrets of real estate investment, explore different types of properties, and gain valuable insights into market trends. Stay tuned to learn how you can make informed decisions and maximize your returns in the dynamic world of real estate. Real estate, understanding the basics. Real estate is a multifaceted term encompassing a wide range of properties and assets. It refers to land, including the natural resources within it, such as minerals, water, and crops, as well as any structures or improvements attached to the land. Real estate holds intrinsic value and can be bought, sold, rented, or developed for various purposes, making it a versatile asset class. Types of real estate, exploring diversity. Real estate can be categorized into several types, each serving different purposes and attracting distinct types of investors. Residential real estate includes properties used for living purposes, such as single-family homes, condominiums, townhouses, and apartment buildings. These properties cater to individuals and families seeking shelter and a place to call home. Commercial real estate comprises properties used for business and commercial activities. This category includes office buildings, retail stores, shopping centers, hotels, restaurants, and other establishments where goods and services are exchanged for profit. Commercial real estate is an essential component of the economy, providing spaces for businesses to operate and generate revenue. Industrial real estate encompasses properties used for manufacturing, warehousing, distribution, and research and development activities. Industrial properties include factories, warehouses, distribution centers, manufacturing plants, and research facilities. These properties are crucial for supporting industrial operations and supply chain activities, playing a vital role in economic production and trade. Agricultural real estate consists of properties used for farming, ranching, and agricultural production. This category includes farmland, ranches, orchards, vineyards, and other agricultural properties where crops are grown, livestock is raised, and agricultural products are cultivated. Agricultural real estate plays a vital role in food production and agricultural economies worldwide. Special purpose real estate refers to properties with unique characteristics or designated uses. These properties serve specific functions and cater to niche markets. Examples of special-purpose real estate include hospitals, schools, churches, government buildings, prisons, sports stadiums, amusement parks, and cemeteries. These properties have specialized features and infrastructure tailored to their intended purposes. Real investment, building wealth through real estate. Real estate investment involves acquiring properties with the goal of generating income and building wealth over time. Investors can earn returns through rental income, property appreciation, or both. Real estate investment offers several advantages, including potential for appreciation. Real estate values tend to appreciate over time, driven by factors such as population growth, economic development, and market demand. Investing in properties with growth potential can yield significant capital appreciation over the long term. Cash flow. Rental properties generate ongoing rental income, providing investors with a steady cash flow stream. Rental income can be used to cover operating expenses, mortgage payments, and property maintenance costs, while surplus income contributes to the investor's bottom line. Hedge against inflation. Real estate often serves as a hedge against against inflation, as property values and rental rates tend to rise with inflationary pressures. Investing in real estate can help preserve the purchasing power of capital and protect against the erosion of wealth caused by inflation. Portfolio diversification. Real estate investment diversifies portfolios, reducing overall risk by spreading investments across different asset classes. Real estate exhibits low correlation with other financial assets, such as stocks and bonds, making it an effective diversification strategy for investors seeking to mitigate portfolio risk. Real estate market dynamics and trends. The real estate market refers to the economic system of buying, selling, renting, and developing properties, including land, buildings, and natural resources. It encompasses the interactions between buyers, sellers, developers, investors, lenders, and other stakeholders involved in real estate transactions. The real estate market is dynamic and influenced by various factors, such as supply and demand dynamics, economic conditions, demographic trends, interest rates, government policies, and market sentiment. Within the real estate market, properties are bought, sold, rented, or developed for residential, commercial, industrial, agricultural, and special purpose uses. Residential real estate includes properties used for living purposes, such as single-family homes, condominiums, townhouses, and apartment buildings. Commercial real estate comprises properties used for business and commercial activities, such as office buildings, retail stores, shopping centers, hotels, and restaurants. Industrial real estate consists of properties used for manufacturing, warehousing, distribution, and research and development activities, such as factories, warehouses, distribution centers, and manufacturing plants. Agricultural real estate includes properties used for farming, ranching, and agricultural production, such as farmland, ranches, orchards, and vineyards. Special purpose real estate refers to properties with unique characteristics or designated uses, such as hospitals, schools, churches, government buildings, prisons, sports stadiums, amusement parks, and cemeteries. The real estate market operates through various channels, including real estate agents, brokers, multiple listing services, MLS, online marketplaces, auctions, and direct transactions between buyers and sellers. Market participants rely on market data, research, and analysis to make informed decisions about buying, selling, renting, or developing properties. Real estate professionals, such as appraisers, analysts, consultants, developers, investors, lenders, and property managers, play critical roles in facilitating real estate transactions and providing expertise and services to market participants. Market analysis involves assessing supply and demand dynamics, pricing trends, market fundamentals, and competitive forces to identify investment opportunities and risks. Real estate professionals use various tools and methodologies, such as market research, comparative market analysis, financial modeling, and risk assessment, to analyze market conditions and make informed decisions. Financial analysis evaluates the financial performance and viability of real estate investments, considering factors such as rental income, operating expenses, financing costs, capital expenditures, and potential returns. Risk management is crucial in real estate investment to mitigate potential losses and maximize returns, involving strategies such as diversification, hedging, insurance, contingency planning, and due diligence. The real estate market is subject to cyclical fluctuations, with periods of expansion, contraction, and stabilization influenced by macroeconomic trends, market dynamics, and external factors. Understanding the dynamics and trends of the real estate market is essential for investors, developers, lenders, and other stakeholders involved in real estate transactions, as it impacts investment decisions, asset values, financing options, and risk exposure. By monitoring market conditions, conducting thorough analysis, and adopting strategic approaches, market participants can navigate the complexities of the real estate market effectively and capitalize on opportunities to achieve their objectives. Market analysis. Real estate market analysis is the systematic evaluation of various factors and trends within a specific real estate market to understand its dynamics, opportunities, and risks. It involves gathering and analyzing data related to supply and demand, pricing trends, market fundamentals, and competitive forces to provide insights for investors, developers, lenders, and other stakeholders involved in real estate transactions. Key components of real estate market analysis include 1. Supply and demand dynamics, assessing the balance between the availability of properties, supply, and the demand from potential buyers or renters. This includes analyzing factors such as population growth, housing inventory levels, new construction activity, and demographic trends impacting demand. 2. Pricing trends, examining trends in property prices, rental rates, and housing affordability within the market. This involves tracking historical price data, comparing prices across different property types and neighborhoods, and identifying factors influencing price movements, such as interest rates, economic conditions, and housing market cycles. 3. Market fundamentals, evaluating fundamental factors shaping the real estate market, including employment trends, income levels, population demographics, infrastructure development, and regulatory policies. Understanding these fundamentals helps assess the overall health and stability of the market and identify long-term growth opportunities. 4. Competitive analysis, analyzing the competitive landscape within the market, including the presence of other real estate investors, developers, property management companies, and brokerage firms. This involves assessing market segmentation, identifying key market players, and understanding their strategies, strengths, and weaknesses. 5. Market segmentation, segmenting the market into distinct submarkets based on factors such as property type, location, price range, and target demographic. This allows for a more granular analysis of specific market niches and helps identify investment opportunities tailored to different investor preferences and objectives. 6. Forecasting and projections, using historical data, market trends, and economic indicators to forecast future market conditions and performance. This involves making projections regarding property values, rental income potential, vacancy rates, and other key metrics to inform investment decision-making and strategic planning. Financial analysis. Financial analysis evaluates the financial performance and viability of real estate investments, considering factors such as rental income, operating expenses, financing costs, capital expenditures, and potential returns. Investors use financial metrics such as net operating income, NOI, cash-on-cash return, capitalization rate, cap rate, internal rate of return, IRR, and return on investment, ROI, to assess the profitability and risk-adjusted returns of real estate investments. Long-term investment in real estate. Long-term investment in real estate offers several benefits for investors seeking to build wealth and achieve financial independence over time. Real estate is a tangible asset class that provides stable cash flows, capital appreciation, tax advantages, and portfolio diversification benefits. Long-term investors can take advantage of these benefits to generate passive income, preserve capital, and create generational wealth for themselves and their families. Real estate investments have historically delivered attractive risk-adjusted returns over the long term, outperforming other asset classes such as stocks, bonds, and cash equivalents. According to research studies and empirical evidence, real estate investments have exhibited low volatility, high income stability, and strong capital appreciation potential over extended investment horizons. By adopting a long-term investment strategy and focusing on fundamental value drivers, investors can capitalize on the wealth-building opportunities offered by real estate markets. Risk management diversification. Risk management diversification is a strategy used by investors and organizations to mitigate the impact of potential losses by spreading investments across different assets, industries, or geographic regions. The primary goal of diversification is to reduce overall risk by not putting all your eggs in one basket. By diversifying their investments, individuals or companies aim to reduce the impact of adverse events affecting any single investment. For example, if one sector of the economy experiences a downturn, investments in other sectors may remain stable or even perform well, offsetting losses. Diversification can be achieved through various means, including investing in different asset classes such as stocks, bonds, real estate, and commodities, as well as by investing in companies across different industries or countries. The key is to create a portfolio that is not overly reliant on any one particular investment or type of investment. While diversification cannot completely eliminate the risk of investment losses, it can help to manage and minimize risk, providing a more stable and consistent return over the long term. It's important for investors to carefully consider their risk tolerance, investment goals, and time horizon when implementing a diversification strategy. Difference between real estate and property. While the terms real estate and property are often used interchangeably, they have distinct meanings and implications within the context of real estate investment and ownership. Real estate refers to land and any improvements attached to it, such as buildings, structures, and natural resources. Real estate encompasses a broad spectrum of properties, including residential, commercial, industrial, agricultural, and special purpose properties. Property, on the other hand, refers specifically to individual parcels of land or real estate assets. Property represents ownership rights and interests in real estate, including legal titles, leases, easements, and other property rights. Property can be owned outright or held under various forms of ownership, such as fee simple, leasehold, joint tenancy, tenancy in common, and condominium ownership. How to invest in real estate. Some of the most common ways to invest in real estate include homeownership, investment or rental properties, and house flipping. One type of real estate investor is a real estate wholesaler who contracts a home with a seller, then finds an interested party to buy it. Real estate wholesalers generally find and contract distressed properties but don't do any renovations or additions. The earnings from investment in real estate are garnered from revenue from rent or leases and appreciation of the real estate's value. According to Adam, which oversees the nation's premier property database, the year-end 2021 U.S. home sales report shows that home sellers nationwide realized a profit of $94,092, a 45.3% return on investment, up 45% from $64,931 in 2020, and up 71% from $55,000 2 years ago. Real estate is dramatically affected by its location and factors such as employment rates, the local economy, crime rates, transportation facilities, school quality, municipal services, and property taxes can affect the value of the real estate. Investing in real estate indirectly is done through a real estate investment trust, a company that holds a portfolio of income-producing real estate. There are several types of REITs, including equity, mortgage, and hybrid REITs, and are classified based on how their shares are bought and sold, such as publicly traded REITs, public non-traded REITs, and private REITs. The most popular way to invest in a REIT is to buy shares that are publicly traded on an exchange. The shares trade like any other security traded on an exchange such as stocks and makes REITs very liquid and transparent. Income from REITs is earned through dividend payments and appreciation of the shares. In addition addition to individual REITs, investors can trade in real estate mutual funds and real estate exchange-traded funds. What a real estate agent does: real estate agents usually specialize in either commercial or residential real estate. In either case, their duties largely depend on whether they work for the buyer or the seller. Agents who work for the seller, known as listing agents, advise clients on how to price the property and prepare it for sale. They commonly supply tips on last-minute improvements to boost prices or encourage faster offers. Seller agents market the property through listing services, their network of professionals and others, and advertisements. Agents who work for the buyer search for available properties that match the buyer's price range and wish list. These agents usually look at past sales data for comparable properties to help prospective buyers create a bid that is at least Thanks for watching today's video. We hope you found valuable insights into the diverse world of real estate. If you enjoyed this content, don't forget to like, share, and subscribe for more informative videos.